The Vox Markets Podcast with Justin Waite. Nothing in this podcast is intended as investment advice, and the people in this podcast may hold positions in the stocks they talk about. Do not buy anything based solely on a tip or recommendation. Please do your own research.
Welcome to the podcast on Friday, the 26th of March, 2021. On the podcast today, Wendy Lawrence, CEO of Totally Plc. And Wendy talks about the Integrated Urgent Care Framework Agreement and the contract extension they've signed worth around £6.6 million. Also, Paul Hill, full-time investor, equity analyst, gives his view on the market, and we discuss the following stocks: Trufin, AstraZeneca, Polarean, Oncimmune, Equals, Aviva, and Lloyds. And there may be a few others in there as well. Plus, at the end of the podcast, two lists for you: the top 5 most followed companies on Vox Markets in the last 24 hours, and the top 5 most read RNSs too. By the way, you can check out both these lists at voxmarkets.co.uk. We'll see lots of other content. It's an article there on Ardent Partners, Argo Blockchain, Shield Therapeutics, Totally as well. Plus, there's one in there on Open Orphan. And don't forget, check out our COVID-19 index. Biggest riser on the COVID-19 index today is Omega Diagnostics. Very popular one, that popular stock. 85 pence, up 7.6%. Biggest faller, Gene Drive, down again, down 14% to 68.5. Wow, it's a big drop there. Check that out at voxmarkets.co.uk.
Vox Markets is an online community of investors that runs a free mobile and desktop platform that allows you to track news and updates about any UK-listed company, offering RNS push notifications, detailed charts, pricing data, and much more. Find out more at voxmarkets.co.uk/app.
And joining me on the podcast right now is Wendy Lawrence, CEO of Totally Plc. TLY is ticker there. Wendy, thanks for joining me.
Thank you, Justin. Good morning.
Yes, good. You got some decent news out here. So you got two sort of agreements, one an additional contract worth around about 6.6 million. We'll talk about that in a bit. Before we do, if people are listening and never heard of Totally, can you explain what it's about, please, Wendy?
Yes, of course. Totally is a healthcare provider organisation. We work closely with the NHS and other healthcare systems across the UK, delivering frontline services, managing demand and delivering patient care.
Yeah, before we get into these contracts, what's it been like of late, the transition? Because, of course, we've gone through is it third wave or second wave? A massive wave, of course. Then most people are going into hospital, but now it's dropped off a cliff with the vaccines and the lockdown happening. How has it changed from your point of view?
Okay, yeah. It's been really, really busy throughout the year, as we've talked around continually. And obviously, demand for access to service completely changed. You know, everyone was asked to go online to access service and not turn up face to face. So you see a big shift. And at the same time, obviously, hospitals were busy, so elective care slowed down. What we're seeing now is obviously vaccinations are, going at a pace. The demand for 111 services has decreased a little bit. It's increased a little bit recently as schools have gone back, but not necessarily with COVID, but with a variety of kids going back to school ailments. But obviously people now are returning more to normal, so elective care has resumed and people are starting to walk back into hospital again. So it's busy. The opportunity and the demand is huge, but it's a little bit more manageable than it was. It doesn't feel quite like the crisis that it was this time last year.
Yeah, good. And that demand, like I say, it's always going to be there, but you've had exceptional demand going to just high-level demand, I suppose, have you?
Yes.
Yeah.
I mean, we saw, it's hard to believe that it's a year ago. In some ways it feels a year ago, but in other ways it doesn't. The demand that came in then was, I don't think anybody could have foreseen it. I don't think anybody thought it was going to last this long, but it did. And I think now everybody's just trying to work out what that new normal is, because I don't think any of us expect it to go back to pre-pandemic, because I think we're all very clear that coronavirus is going to be around for some time yet, but hopefully not in the big waves that we've seen during the last year.
Yeah, okay. So there's news out today. You've got an agreement with Yorkshire Ambulance Service and, of course, as the Vale of York Clinical Commissioning Group. Take us through those if you could, Wendy.
Yes. It's really pleasing. and I think, this is a result of using the new commissioning process that the NHS outlined a few months ago, which I know caused some concern for people. But we've gone through a formal process now with Yorkshire Ambulance Service and the Vale of York to provide a new service, which is around Vocare, which is part of our urgent care division, carrying out all of the validations of the calls that come in via 111 in Yorkshire. But anybody who is required to go on and receive further service, so our clinical assessment service, which is a group of multidisciplinary practitioners, will review all of those calls from the patients and get them into the most appropriate service for them as quickly as possible. So it's still around delivering that high quality care quickly and efficiently, but on this occasion supporting Yorkshire Ambulance Service to make sure that everyone is spoken to very, very quickly and gets to their final destination. So really exciting. It's a new service, but it's a very much the new way of how services will be commissioned going forward. So it's particularly pleasing when it's the first one that you've gone through and you're successful.
Yeah. And this new commissioning service, are you comfortable with that? Are you happy with it? I mean, you did say some shareholders expressed concerns, but has those concerns now been sort of, quashed?
Well, for us, we saw it as an opportunity. What it's done is, previously with every public sector tendering exercise, it can take anywhere between 9 to 13 months to actually go through all of the hoops and the barriers to finally secure new work. This one was actually completed, I think it was 11 weeks from start to end, which I know some people will go, that's still a long time. It really isn't when it comes to public sector tendering. So for us, I think it will mean that we can be much more agile, responding to commissioners' needs and making sure that services are mobilised very, very quickly. And obviously now we're on a framework with the Vale of York Commissioning Group and Yorkshire Ambulance Service. So if there are other things that they need, we're on that framework. We've gone through a process and they can talk to us and draw down new services very, very quickly. So it's great because it's taken a lot of the bureaucracy away.
Yeah. And so looking forward, are you quite optimistic? I mean, looking at your chart there, it looks phenomenal. From this time last year, you've gone from 10 pence up to 32 pence. But are you looking forward with optimism?
Oh, absolutely. I mean, when you think about, the overall impact of the pandemic has meant that we've seen great demand, but at the same time, elective care was paused because hospitals were very, very busy. What we're seeing now in our insourcing division is as elective care starts up again, waiting lists have grown massively, as you will have seen in the press. And we are now being asked to work with lots of organisations to look at how we can help them reduce those waiting lists and get the backlog of patients seen. So, no, it's all very positive. It's very busy in a different way to what it has been for the last 12 months. But no, the opportunities remain very, very good across the organisation and across all three divisions.
Excellent stuff. Okay, well, Wendy, every time you come on the podcast, of course, I ask for 3 reasons why someone should hit that follow button. So if someone's listening right now and they're not following you, give them those 3 bullet points if you could.
Well, I think the 3 bullet points have got to be, I mean, you've just said it yourself, look at the chart over the last year in terms of where we've gone as an organisation. We've proven ourselves that we can stand shoulder to shoulder through the most demanding times in healthcare, and that we certainly have all the opportunities in front of us and the track record of delivering, which means I believe we are certainly a company that people should be looking at and get interested in.
Excellent stuff. Wendy, good to chat to you as always, and hopefully we'll be catching up in the not too distant future. Thank you very much.
Thanks very much, Justin.
The Vox Markets Podcast with Justin Waite.
Welcome to the podcast. I'm joined by full-time investor, equity analyst, all-round spreadsheet super guy, Paul Hill. You all right, fella?
Yeah, morning, Justin. I've definitely been bashing a few spreadsheets this week. But before I sort of go into that, you hang...
Hey, how often do you bash a spreadsheet? How often do you open a spreadsheet? Do you do it every day? Is that the first thing you do? Or what do you do? What's the first... In the morning, your morning routine, because it always fascinates me. When you get up, what do you look at? I mean, most people, the first thing they pick up is their phone and look at that. But when do you actually, financially, what do you look at first of all?
Well, it depends on what time I wake up. Like last night, it was about 11:45, so I turned on Bloomberg and got their late closing prices. And
Hang on, you saw quarter to midnight you woke up?
Yeah, well, sometimes I don't sleep very well.
What time do you go to bed?
Last night was about 8:00. I was hoping to sleep a bit longer, but I just couldn't get to bed. So, and then
I had a problem Thursday. Go on.
And then it's sort of like all changed. So I usually sort of like watch a bit of, just sort of catch up on the news, see what's happening. If usually nothing's really of note. And then after sort of bash in, whether it's a research report or whether it's basically doing some modelling or whether it's reading up what's been happening in terms of stocks and sectors and stuff like that. Yeah, so it's a fascinating way I hold my life.
How long is it until you open up a spreadsheet? How long to spreadsheet?
I know I usually have my spreadsheet out all the time.
I see.
I usually go to sleep with it.
Yeah.
Anyway, regardless of my spreadsheet, you had me sort of like in suspense and the rest of us sort of like hanging on a thread 2 weeks ago when you were saying, I'm going to pull the trigger on this FinCap stock. And apparently it's Trufin. I've never even heard of it before. But tell us about it. How much money?
Well, I tell you how I heard about it. The guy, the IR guy, this is a PR guy for financial PR, behind Escapant, just got into contact with me. He said, there may be an interesting thing here. Have a look at it. He said, we haven't done any publicity on it because there's a reason for it. There's a fund who holds 75% of it. It's closed and they want to get rid of the stock. And so they placed now about 50% of that. They've got about 20% left. But it's very interesting because it's in a very hot area. Let me just share the screen with you, right? And in a very hot area, I'll take you through the presentation here. I looked at their results. First of all, you look at their results, right? And they are going to make a loss historically, of course, but their revenue doubled, right, to 14.6 million. And that was largely down to they own 4 companies. One is PlayStack, which is a gaming company and a fund as well. The others are basically fintech companies. But PlayStack went gangbusters last year because one of their games, and they've got many games, so let's go through this. Many of their games is, so these are the 4 companies, but many of the games is Oxygen, there's Virtus, there's Stargo. In fact, Stargo I talked to you about. They've just done a deal with Lloyds, a trial 6 months.
Oh, yeah, that's what you remember. Yeah, that's what you saying, wasn't it? Yeah, okay.
Yeah. They do invoice of small and medium-sized enterprises, invoice management software. So basically, and they've shown that, and I'll show you this slide, but they did a 6 months trial with them. But if you read the update with Lloyds, the guy from Lloyds doesn't sound like it's a trial. It sounds like it's a done deal. We'll know by June whether it's a full-on deal going ahead. I think it will be because they're plugged into it and it's pretty much. But PlayStack, Mortal Shell was a hit they've just had, and it's gone pretty much global. And this is the hardest thing about games. They've got loads of games, but the hardest thing about getting a big hit in a game is getting that traction. First of all, the big hit. Once you get that, then you do the sequel. And it's not like, I like films, the sequels don't flop because you get more, you've got an installed fan base then. Initially you don't have a fan base.
Just to my understanding that it's a fintech company that has developed a game.
No, they didn't develop it. They basically bought this company out called PlayStack, and I'll go through. So this is PlayStack, right? It's 4 bits to it. It's a publishing company. It's a development fund, award-winning. But these are all the games they do. So this is one part. They own PlayStack 100%. And the same thing happened with Stargo. In fact, my membership group, oddly, there's a guy in there who came on the webinar on Wednesday. He talked about Stargo. His brother used to own Stargo. And he just didn't have the cash to keep going. So he's going gangbusters.
Just rewind. 2 weeks ago, you gave me a kicking for owning Northbridge Industrial because it had 2 separate businesses, and you're saying this is a fintech business and a gaming business, which frankly have no synergies at all between each other.
Of course, they do. It's tech. It's fast growing. They double their revenue in a year. Listen, it's tech.
I understand that.
Look at that, Doctor. But no, listen. What I'm saying is, if you read their last update, they are disposing of several, probably 2, maybe even 3 parts of the business, because they've done this before. They did hold, I don't know if you ever heard a distribution finance, DCF, have you ever heard of that company? There's a startup bank, they spun that off, return money to shareholders. So they do this quite often. And so I said to James, the CEO, I said, listen, the problem you got here is you've got 4 stories going on in once. And even though 3 of them are quite exciting, private investors, can't get their head around all that. You need a simple story, but they are going to be streamlining this. And they did mention in the last update, they're looking to sell 2 of them at least, maybe 3. But yeah, this game has gone gangbusters anyway, and it's really given the cash flow of the business. But Epic Games, of course, publishes a Fortnite. So
basically, they're a gaming company with some fintech businesses, and they want
PlayStack was the last thing they acquired. So they were a fintech. They had something else, but they were a fintech and they brought this on. I don't know what happened. I think it was some kind of deal went on there, but it turns out to be another star of the portfolio, and it's growing very quickly. But what I like, let me go to they've also got.
I agree.
This is integrated gaming software. This is advertising within. This is a bit like BidStack. This is what BidStack have. They have hit games, and they have this, which is like dynamic advertising within the games. But this is Stargo, right? And this is the website. But if you look at this, 70% reduction in unpaid invoices over a month after using Stargo software. So Lloyds views it as a white label. Okay, so this is the growth organically, but now this has gone berserk because commercial pilot with Lloyds expected to lead to a 5-year commercial agreement, and they say this is expected to have material positive impact on the financial expectations of Stargo. And if you look at Ben Stevenson, he's the MD and head of invoice financing at Lloyds Bank. He just says, I'm delighted to partner with Stargo in order to rapidly launch the best-in-class digital working capital solution for our clients. The proposition will help deliver critical funding and digital tools to small businesses in the UK. I didn't realise how big Lloyds were compared to every other bank in the UK. I mean, I was looking at the market share. They're at, I mean, I can't see that from the other way, but they're up over 20-odd%. The next one down is Barclays, 15. So you can see that, it's going to have a massive impact. Now, there's other parts. There's like Auction Finance. This is the market leader. Just
before we move on from to Chicago, what will happen there, in my view, is if that pilot works, Lloyds will buy that business.
That's what I thought. Why wouldn't they buy it? I know. That's what I thought. So they're already thinking of selling Oxygen and Virtus, the other two. But if the target sold to Lloyds, it'll just be PlayStack then, the gaming company,
Yeah.
So, but Oxygen is another part of this is an early payment system between public governments, government bodies, and people who supply services to them. They are the biggest. They're the market leader in this. They've got recurring revenue, 5-year contracts, 94% client retention, 90% contracted revenue going forward. Now, all these companies are at sort of inflection points of going to cash flow positive. They're all now starting to get EBITDA positive. So, if you look at it, they're valued at 65 million. The company altogether, Trufin, 15 million in cash. So each of these companies, if he's going to split them equally, not more than a 10 million quid each, And so I just think they're in quite a few areas here. Like I said, EBITDA profitability, this is for Oxygen, and Oxygen's dominance continues. This is Virtus, another part of the company. A bit boring, but it's independent. In fact, you'd quite like this. We're able to enable ownership succession between the independently minded financial advice firms in the UK. They make it possible for owners to sell their business to like-minded firms. So another bit of financial tech there. They're not looking at that.
Outside of gaming, what's its unique USP?
Who?
Adam, what is Trufin's in the fintech side? The three businesses. What is its USP?
Well, it's USP. That's basically. Is there any other company like that with 4 bits? Is that small? That many cash? Market leaders in their fields, and yet they're going to profitability now on all things. I just think it's an undervalued company. And PlayStack, for example, that's going to be a massive hit. Mortal Shell 2 will be a big hit, bigger than Mortal Shell 1, because you've got that million people fan base already now installed. I don't know. I liked BidStack's tech before, but they've got BidStack times 10 with it because they've got a portfolio of games already and publishers, and they've got a fund there that they fund future games makers and games writers. So I don't know what's going to happen with this. I'm very interested. Now, Aragras is the fund, right? Well, look at this. This is James, this is the CEO. But Aragras, I don't know if you've noticed the fund. Aragras there, they held 73% of the company, right?
Yeah.
They've sold down 53%. They've placed it by 45 pence. But I tell you what's interesting, Holy. I don't know if you've ever heard of this. Have you ever heard of Watrium? They are from Norway. They're a big family office, right? These are the guys there. They're basically the family office of the Caribbean cruise liner. And they hold companies for generations. They own 21% of the company. Yeah. And so the shareholders base is very stable. But and if you look at the buyers, here was J. Hambro, Lombard, Gresham House.
They're all smart cookies, those guys.
Yeah. So they all took that placing stock at 45 pence from Aragras. Aragras got 20% left, got 19.9%. So I don't know where this is going to go, but I just think there's very many exciting parts of the business. Probably the most exciting is PlayStack and Stargo. The deal with Lloyds is very exciting, and Mortal Shell 2 is very exciting. So I don't know where it's going to go, but they won't have 4 companies in about a year or two's time. It'll be one play and plenty of cash. And they've done it before. They've returned cash to shareholders, when they've sold businesses. Like DCF Finance is called, Distribution Finance. That was a bank, a startup bank, they spun that off and they loaned them to the 9 million, and that's been returned to shareholders.
Last question then, Justin.
Yeah.
How much is the stock worth?
Do you know, it's hard at the moment because I want to see, they're going to have results out soon in April. But again,
you know what I'm going to say next?
Yeah.
You need spreadsheet-itis like me. Yeah. Get on those spreadsheets, mate.
I'm going to say it's a 5-bagger at least.
I'll hold you to that in 2 years' time, okay? No,
but what I think is going to happen is money will be returned to shareholders, and then the structure will become a lot more simple. Because at the moment you've got these 4 parts of the business. It'll become a lot more simple. Maybe they'll have 2 parts, maybe 1 part. Because I agree. Do you know what? I was just in the shower just then thinking about Chicago. And I thought, do you know what's likely to happen to that? Is Lloyds just buy it?
Yeah, they will. If that works, they'll buy it. They'll bring it in-house, no doubt about it. I think it's a really interesting unbundling opportunity, realising, value, no doubt about it.
Yeah, and in fact, let's just put look at the chart. It's quite nicely starting to build here. This is the placing area. Where is it? 45 pence from right here. And it's slowly creeping up. It's a nice trend here. All these lines, which are moving averages, are moving upwards in the right direction. So, yeah, I think it's an exciting year ahead for them because they haven't shouted about it because they've had this overhang of stock. And they said there's no point of doing that because every time the share price rises, they made that jump stock. But I think they're going to place the next 20%, hopefully, again, at a higher level. That's why Aragras didn't sell it all because they realised they could probably sell a bit more higher up. So yeah, but... I just like it. It's the options they got there.
In contrast, in the last 2 weeks, I've bought a really, really exciting large cap pharma company called AstraZeneca.
Have you bought them? Have you?
Yeah, okay. No. I basically just finished off my portfolio. I've got a baker's dozen now. I've got sort of 12 stocks plus my house, which gives them a baker's dozen, and I've got very little cash. So I just utilised almost sort of like another 4 or 5% of cash, and basically. It'd been sold off and still is due to the vaccine news. And the pipeline for AstraZeneca is absolutely fabulous in oncology or immuno-oncology and also in sort of like cardiovascular, respiratory, immunology and all kinds of stuff. And it's just, looking at, they're going to do $5 per share this year. And if you put that into the sort of like into your spreadsheet, you get sort of like a 19, 20 times PE ratio, given the current share price. But this is going to grow EPS by 20% over the next 3 or 4 years easily, and probably over the next decade. And on that basis, it's got a PEG ratio of about 1, which is basically fair value. And these are mostly new drugs it's got on immuno. So I think it'll hit $8 per share in 2023. In EPS, you put a sort of like a market multiple, or keep it the PEG ratio. You get a share price of around about $160 on a 20 times, which would be a PEG ratio of 1. And you basically then put that back on the exchange rate. You get sort of £115 per share compared to a £71 per share current price. And for a big cap, which is largely probably in the top 3 in the FTSE, plus a 2.5% dividend yield. It was a no-brainer for somebody like me. It's not.
Do you know what? It's like talking to a calculator.
I'm a numbers man. Man.
Do you know? I'm looking at the chart there. It's funny, isn't it? They've dipped literally nearly. Look at that.
It's a joke. It's a gift. If you're a big cap, investor, and we talked about this in detail last 2 weeks ago. You go for the best-in-class technology. These guys in immuno-oncology, along with Merck, are and probably Bristol Myers are pretty damn good, and Roche. But those are by far and away the top 4 oncology companies. And there's going to be a golden era of medicine going forward because...
Yeah. Well, so what are you expecting? What return then are you hoping to get for that over the next few years there?
I think gross return, you can get basically... You can get high teens on this. 15 to 20% is certainly not unreasonable. As I say, if you work out £115 per share is a normal value, a fair value for the stock in 3 years, that's 60%, 50, 60% return on its current level. plus you get a 2.5% dividend yield, the maths works out 15-20% per annum return. I mean, it seems like a no-brainer for a big market cap. And they just bought Alexion, which will be accretive to the to EPS in a couple of years' time. I mean, I just thought it was a gift, so I just took it, basically. Yeah. I just thought...
Do you see what's happening recently with the politics in Europe? I think that's criminal, almost criminal, the way they've, sort of talked about AstraZeneca, and then all of a sudden we get these figures come up from America. Phenomenal figures of 100% of reducing sort of severe illness. And it was fun. And it, you got Macron playing the politics because Sanofi failed pretty much. And they're also, we don't want AstraZeneca. Now they're saying, give us AstraZeneca. It's like they're panicking. It's like, I know it's ridiculous what they've done there. It talks about big bureaucratic, a lumbering body that can't move, which is lumbering around, doesn't know what to do, Yeah,
I think the populace in the EU are just flabbergasted by the incompetence of what's been happening, and now they're putting export bans. Essentially, they're not in those words, but they're effectively saying they're not export bans, but we're not going to export anything because we're going to use it ourselves. The problem is that they've muddied the water so much that the actual electorate now don't want to use it. I mean, it's absolutely. But anyway, regardless, it's a gift. In my view, if you want a large cap pharma company, and I was looking for one, then that's a gift to me. If you're prepared to hold that 3 to 5 years, you'll make 15-20%. And frankly, I'll take that any day for this type of quality business with unbelievably good technology, and science. So that was do
you know what I found that if you look at I keep mentioning the chart here. By the way, if you're listening on podcast, you can look at this on video. You see the chart on the screen. The thing is, as you know, you're more a figures man than technical man, of course. I look at a bit of both. They bounced not far from that March dash for cash crash we all saw. They spiked down like $61 dollars, and they punched back up to sort of towards 96. But they've been rolling over now. Now they're below the moving average, 200-day moving average. That's the red one there. That's seen as the bull bear line essentially, the trend. Trouble with these big stocks, they can grind low for a while, can't they? Have you put everything in, or do you scale in or not? They pay a dividend. What's the dividend? No, they don't pay dividends.
Scaling! Well, that isn't even in my lexicon, Justin. I just dump some money straight into it. That's what I do.
And you don't mind if it grinds low for another year or so?
Hey, that's part and parcel of what I do. You can never buy at the bottom, you can never sell at the top. You just try and make a profit in between and get a nice dividend if you can. This is in my view, if you're looking for a gift of a large cap at these current levels, and you just want a good steady return over the long period, hey, Astra fits the bill. It's been sold off because of these, problems with sort of the, coronavirus, and also fears that, basically they're not going to manufacture enough and they're going to, but anyway, and also because, part of the whole sort of like last year is that a lot of their patients haven't been able to be treated because of, cancer screening and cancer treatment and all that. That's all coming through. You're going to get a golden period of medicine on top of, sort of like, all this pent-up demand, which will happen when it will come through. I mean,
the last time Astra sort of went into a downtrend like this currently was in 2015, and it crossed over that 200-day moving average in April, June 2015, managed to get back above it a year later. So it may take a little bit because these juggernauts of stocks.
Anyway, moving on. What else have you done with your portfolio this last 2 weeks? You been selling anything or buying anything more?
No, I haven't sold any. Well, I've sold a little bit because I've got very little cash, and I've been buying something else. I'm not going to tell you yet. Because,
not this again. Not this like cat and mouse.
No. Whenever I talk about a stock, right, I like the share price to be in the right position. I don't like any spikes that happened. And a stock I sort of bought a little bit of, not a lot and not enough, just spiked, and it annoyed me. And so whenever I sort of talk about stocks, and even when I share a video on stock, I hope the chart is okay. It's not spiked out or anything. It's in a reasonable level where you can say, okay, I can start getting into that. Anyone can start getting in after doing research. So I'm going to wait for this stock to calm down. I want one bit more information, but I like it. It's in a hot area. It's a micro cap, and I was looking at just all my previous decent winners, and they've all come from micro caps. I'm talking sub 10, sub 20 million market
cap. Which part of the micro cap? Where is it? Technology, gaming?
It's sustainable, renewable, sort of very hot area. Before we went into pandemic, there's one theme that everyone was talking about, and I'm not going to say anything else. Don't you even guess? I'm not going to say yes or no. But and then all of a sudden, that moved aside for the pandemic, and we've heard very little about that kind of worry we had. But it's in that area, But
okay, and when you going to spill the beans on it? A couple of weeks' time?
I don't know. You can see my portfolio here. Look, it's trackwise up. Trackwise had a fall down bounce today. What happened yesterday? Do you know what happened yesterday in the small cap arena?
It's been rolling over a lot. The Russell 2000 in the States has rolled over big time. It's basically what it is. People just de-risking. That's all it is, and it's largely the algos.
Yeah. Well, do you know what? It reminded me. I don't remember a couple of years back, a London broker went through, a small cap broker went through, and all of a sudden everything sold off they had, and liquidity issues happened. It reminded me of that yesterday. Thursday was really odd. It's like, if you look at the main indices, all indices are down, but AIM was down the worst. Like the big indices were down like 0.5%, and AIM was down like 1.4% pretty much. And I think, well, what's going on there? And every one of my stocks was red. And when you get a day like that, psychologically, it can be quite hard if you're a new person as well. And you're sitting there and not just one or two, but every one of your stocks is red. And it's just different degrees of loss, And you think, wow, psychologically, that's very hard sometimes. And you can see why, even the pain of a stock going down is twice as hard as the pleasure that you feel of a stock going up, But again, we all know we've been there before. We've been in some of the worst sell-offs ever, and it's always sort of rebounds, doesn't it? And that's psychological thing. It's the thing people have to get over, not sell, because some of the big bounce days are the days after that big sell day, So if you sell on a down day, you're going to miss that bounce, So that old saying, time in the market, isn't it? It's better than trying to time the market all the time, because I've missed out on several times.
Okay, mate, right. Get your charting boots on. What about Aviva and Lloyds? Because Aviva's come out with some blockbuster sale today of its Polish business. And you gave me so much grief about 9 months ago.
Oh, that's good. Look at that.
You gave me so much grief about 9 months ago for buying them. And they're coming back strong. And Aviva, I'll just give you an update on Aviva, because I'm obviously owning quite a bit of it. I mean, they've restructured the business. They've sold 8 entities overseas. The CEO, who's a superwoman and done a terrific job, Amanda Blom, has just sold the last one, which is the Polish business, for a real absolute knockout price of 2.5 billion euros to Allianz, at a fabulous sort of premium at sort of like 5.7 times book. And what it means is that it adds another 10% to net tangible assets. And frankly, this is tracking up because people are starting to realise that this has got significant upside, and it's a fairly low risk business. And the same is about Lloyds as well, because it's got all these provisions it's going to release, and now that it can release Sartogo's results, the Sargo software as well, I mean, that's going to really spike the shares, So, I mean, when it came down to been selling off, and the economy is not as bad because we've had that reopen on the on the vaccine side. So I'm still very positive about both. And there was good news as well from the US banks, because we saw this movie, and the Fed has decided that it's going to allow the big US banks to pay dividends and to make share buybacks. You can just see that happening mid-year in the UK. And once you get that, then investors are going to return to the dividend plays, and it's going to migrate to net tangible assets on Lloyds of about 50, 55p. And you can see the similar sort of thing for Aviva, which is, I mean, essentially their net assets, if you put it at the end of this year, is £5.80. Never mind the current share price is £4. So there's still a lot of flipping puff left in these stocks. And as you say, what do you think of the charts?
Well, I was going to say, that sticks out to me. Well, I talk about the 200-day moving average. If you look at any moving average, look at that. Look at this here. Do you remember what this day is? Have a guess what this day is. We've punched up a massive volume day. It's a big volume, okay, and then a big move.
Vaccine day.
That was 9.73% up for Aviva, a big stock, of course. That's a big jump. And that was vaccine day, yeah. And it just went straight to the 200-day moving average there. And that marks, technically, we can say, uptrend there. So that's good. And all these moving averages in the right position now. They're all going up. So that's very nice, isn't it? Where would you see a resistance point? Maybe back towards that level here, resistance, but it may go.
Well, I mean, I would say if people were thinking of owning it like I do, and then you're looking to sell, then don't sell at the moment. I mean, I would only consider selling Lloyds at round about over 50p. 50p would be by far and away the earliest. And likewise with Aviva, I wouldn't sell Aviva until it gets to nearly £5, because there's plenty of upside still to go on these, and it's tracking well. And I mean, frankly, they're unbundling, and one benefit of the pandemic is that they're shedding costs like anything. And did you see yesterday's announcement from, was two really, from Santander closing a shed load of banks, which, properties, because it doesn't need it. Perfect. And did you see the one from Nationwide? I mean, it's allowing all its workforce to work at home if they want to, which means they'll be able to reduce their property footprint, which is great. So what you've got is that these businesses will be a lot leaner, and therefore you're going to get the operating leverage going forward. So frankly, what historical norms you've had in terms of cost bases could actually be blown out the water, because there could be a lot. What you're modelling is a lot more conservative than actually what will happen, because the cost base will be much smaller. What's quite an interesting point, I thought, for Invest, and it comes back to your point that you keep mentioning, get involved in investing. Well, why? Okay, because the saying goes now, if you get like Nationwide, if you can do your job anywhere, then somebody else equally can do your job from anywhere. And that means people who are, your traditional white collar skilled workers, etc. If you're not investing or being in a creative industry, then you're actually quite at risk going towards. But investing is a creative industry. It gets you involved and it earns you money that you can do for the whole of your life, and therefore will insulate you from any type of reshoring that you might have on your existing job. So it gives you this pandemic is actually opening the eyes of the world, and investing is a very good way of providing a hedge that it insulates you to a certain extent long term, because it gives you an income stream.
No, I say several times, there's many people in many jobs who don't enjoy their jobs. They're just doing their job because it pays them, money, and that's it. And while they're busy working, they're never going to make any wealth. And I say, simplistically, there's only two ways to build wealth in this world, apart from winning the lottery, pretty much, and that's own a successful business or invest in a successful business. And anyone can invest in a successful business if you've got a bit of spare cash. So you're better off spending an hour or two when you come home from your job that you hate, spend an hour or two learning about investing, because like I say, you can't do it overnight. It's a skill you build up, you get better, you make less mistakes as you get more experience. But once you've got that skill, it'll stay with you for the rest of your life, and you can build decent wealth. And it's only you and the market. You don't need anyone else. You don't need your boss telling you how many hours you can work. It's you and the market. As long as the market's still there, you can still earn money. And I think everyone should be taught from ground level in school about investing, I think, because genuine is a way of building wealth.
The point is the pandemic has made it even more critical that you do, because if you think you're
in fact, when you're saying that, I was saying I was in the sort of weekly webinar with my SHIP investment club, and I was saying, what's good about investing is that, algos do it and all that, but there's no one rule fits all with investing. In different businesses, sometimes I'll go on a lot more gut, and other times I'll go on a lot more fundamentals. And sometimes I think it's going to work. I just got to feel for it. Or the share price is so low, it's so undervalued. And I feel and I understand. And so an AI machine can't sort of do that kind of thing, but you can. They probably can replicate it a little bit, but it's still got a human touch to it. Where it's sometimes you'd see people investing in them, say, what are you investing in that for? And then it goes gangbusters. No idea why, but you have a feeling for it sometimes, and it works. I
want to pick your brains now. Also, what about small cap fundraising? What's the market like? Because I see one of your stocks, Polarean Imaging, raised 25 million quid.
Well, it depends who you are. Well, if you're a company like those, there is a quarter of their market cap size, pretty much, with very little discount, seemingly with existing shareholders.
Oversubscribed.
It's not an issue, and they gave a nod to shareholders, but they needed that cash. They needed cash to get them beyond the FDA approval date, which is on October the 5th. And then to commercialization, which they've done. And that was the only, in my mind, the worrying factor, or the people were worried about. Now that's removed, it's good. But I mean, like I said, if you've got something that's a potential game changer for that industry, then it's not a problem. You get backers, the biggest shareholders took part and all that stuff, directors took part. It's not a problem. It's all about the business, isn't it? You got to go. It always comes back to the business. When people start worrying about certain things like, maybe warrants or things that are, peripheral to the actual business, just think about the business. Like when there's a sell-off yesterday in the markets, I said, listen, think about the business you're investing in. Is it going to be in a better position in 6-12 months' time? If it is, don't worry. You can buy shares cheaper right now if you want to, if you've got spare cash. But if there's a specific sell-off to your share, then maybe look at it and say, what's going on here? But generally, general sell-offs like that, it's
I'm on the same page. If you're a good quality business, the market is actually really ready for you, because the same thing not only happened to Polarean last week, but also happened to Oncimmune two days ago, because they raised £9 million at a 5% premium to the closing preceding day's price, oversubscribed. And I know I'm catching up hopefully with the CEO sometime next week, Adam Smith, I think I remember his name is. And just to remind people, the investors, what it does, it's basically, its lead platform is Immuno Insights, which does two things. It allows effectively next generation diagnostics to be built. So in terms of sort of like being able to diagnose people early in terms of cancer, autoimmune, infectious diseases, and not only to help you can treat these guys earlier, but also you can then, once they've actually been diagnosed, you can modulate say if they've got immune suppressant drugs or your drug regime, such that person gets personalized medicine by using the same diagnostics. And also what it does, which is absolutely fabulous, it helps drug companies, biopharma, better predict how their drugs are going to be when they're received by an individual's or treated by an individual's immune system, how the individual's immune system will react. So it's helping them all of that drug discovery, which is not only improving the efficacy of their drugs, but also helping them design, which is a massive cost for them, their clinical trials better, so they get better efficacy results. And as I say, they've got a portfolio of fabulous customers like Roche and Genentech and people like that. And just to give you an indication of, they announced, I think it was a study they're doing with, I think it was with Roche in rheumatoid arthritis and autoimmune, massive autoimmune, as everybody knows and stuff. And what they're trying to do is decide for a particular customer which drugs are going to work best for that particular patient, and rather than actually just by trial and error, saving the patient a shed load of time, removing its side effects, a huge amount of cost, and tailoring it that whole treatment regime specifically to the individual. So it's real knockout science. They're still sort of like got lots of pipeline opportunities, but it just shows you that if you've got a really, really cutting edge product, then you can get money quite readily at a good price, at a premium 5% and oversubscribed, because investors want to back it. And as I say, I'm really looking forward to speaking to the CEO next week, and or hopefully next week, because it's fabulous technology that people sort of should have a good look at.
Yeah, look at that. From March last year, it's gone from 40 pence to 180 right now.
Yeah. Well, there you go. Yeah, wow. and that could be. I mean, just on valuation, I hate to come back to my spreadsheets again.
Listen, it's nice. So it's see, it's like a football field or rugby field. There's 15 players on the field, all with different styles, and that's what I'm saying. So you like that side of it. I do use spreadsheets now and again, but not as much as that. I like a bit of narrative as well.
Yeah, I mean, what's the market cap currely on it? It's about
116 million. I got there, but obviously it's more now. That's extra 10 grand there, isn't it? So oversubscribed. 116. Dr. Adam Hill, not Adam Smith, is economics, isn't he? But there we are.
So they've got 70 million shares following the last price. Okay, 70 million shares, right? Yeah. So effectively, they've spent 70 million quid developing the pipeline or the actual platform. Typically, these things go for about 4 times, so 280 million pounds. You then sort of like divide by 70 mil, you get 4 quid a share. There you go. That's how much these things will tend.
Again, I didn't hear that. I was looking. 126 million market cap there. So say it again.
So essentially, they've got 70 million shares. They spent 70 million on the platform. On building this platform, which is a whole bunch of proteins and stuff like that to give them the Immuno Insights information. It typically goes for a minimum of 4 times. So 4 times 70 is 280. Divide by how many shares in circulation, 70 mil. You get basically £4 a share, compared to 180. So there's plenty of upside. And also a good trick for investors to give people a bit of sort of like extra visibility, particularly in healthcare. When they partner with people, then you can actually have a look at those partners' websites. Now, their distributor for their key product is called Biodesix out in the States, which is effectively using their early CDT lung cancer test, which is being trialled in the UK and doing well, etc. But in the States, what they've really interesting Biodesix, what they've done is that they've also they've joined it up with one of their own tests, which together, both tests, give a fabulous, absolute fabulous sensitivity and specificity rate. I was absolutely flabbergasted because essentially they're now good. They join it up. Their own test has got a sensitivity of 97%, but the early CD test from Oncimmune has got a specificity of 98%. So put them together and you're going to get a dual test of effectively near 100% for early stage lung cancer. That is breakthrough stuff. And if this works, they're doing a validation trial with over in the States, about 2,000 patients. If that comes out and verifies those stats, I could see this really that product could revolutionise the screening of lung cancer patients around the world, which is by far and away the biggest cancer killer anywhere. And I'll be very interested to see what Adam says. But that it just shows it's all public information. You can pick it off the website. They've got a presentation there, and it tells you the actual numbers. I could be overplaying it. I don't know, because I'm only a layman when it looks at these sort of stuff. But I only picked up the presentation a week or 2 weeks ago, and to me, if that is verified in the clinical trials which come out later this year, that is a well-balanced, highly accurate lung cancer screening test that allows people, to be effectively diagnosed with lung cancer at stages 1 and 2 rather than stages 4 when they rock up into the hospital and effectively they're untreatable and they die within 6 months. But if you get them at stages 1 and 2, the survival rates are just much longer. In fact, you can actually hopefully put them into remission because you're catching it so early. So for patients, it's massive. For treatment costs, it's absolutely huge. And hopefully for Oncimmune and Biodesix, that could be a real winner. And it explains why Biodesix is absolutely recruiting a lot of sales guys to push this out in the States. So it's anyway, if people want to have a look at it, it's public, it's on their website, but it's a really good learning curve for people in healthcare stocks. Any partners, have a look at, particularly if they're listed, have a look at their investor presentations and see if they're mentioned, because if they're mentioned, then it's important. And this one has got about 4 or 5 slides associated with it. So Biodesix, which are about $1 billion business, seriously believe this is going to work. And if their numbers are right, then I do as well.
Yeah. One of the companies you hold, I think you still hold it, had some news out this week, Equals, didn't they?
Yeah, Equals. Basically, it was just really launching a new LinkedIn product, LinkedIn product for their consumer FairX side of the business. But really what it illustrated was the power of their bank grade technology, that you can add on new services fairly quickly into that whole product set to extend the functionality. And they can do that for themselves and they can do it for white label partners. And as I say, the shares have fallen off largely again because you talked about the tech sell-off, but also what's happened in small caps has been a bit brutal across everywhere. But I can see them releasing some pretty good results. Outlook statements anyway at the prelims. Let's be clear about it. We have been in lockdown for 3 months. And therefore, overseas stuff hasn't worked very well for them. I guess, I don't know, but I'm guessing it hasn't. And then it'll really just, it'll really drive on what their view is. But I could see, you've had the chief economist of the Bank of England again saying we're going to have an absolute gangbuster time in the second half of 2021. And these ones, Equals should be right in there with B2B e-payments. So I'm very, again, you can't buy at the top, you can't buy at the bottom, you can't sell at the top. You've just got to accept that if you're a long-term investment, if you can make a good bit of money in between, then frankly that's you're going to do well. And that's how
Yeah,
I
but do
believe
you know
it.
what? But the thing is, you're going to have it's in a range, isn't it? All it needs is a breakout. I mean, it's trading between 25 pence and 40 pence. And so it just needs a break out of that 40 pence level, doesn't it? And sooner or later, I suppose, when the economy starts opening back up, which, I'm confident it's going to stick to that plan of May 17. Look at it, we're nearly into April already. We're 6, 7, 8 weeks away. So I think everything will start moving then,
People want to get out, don't they? It's cabin fever they've got. They want to get out there, enjoy themselves, spend a bit of money. And equals should do really well. I mean, you could easily see a high single-digit GDP print in the UK in the second half. I mean, that just would not be, unusual. Really wouldn't, because you've got £60 billion of cash in consumers' pockets that is going to be spent according to surveys, and you've got much more anyway. So it should.
Part of me, I always try to look on the bright side. I think part of the sell-off as well gives people an opportunity to get in there, and we sort of consolidate from a nice support base, because it's been rallying. I remember like a month back on the weekend podcast with mates and Steve, who's probably the least active researcher amongst us all. The level of his research is what's the ticker on that one? And that's the level of his research. But he said my portfolio is hitting all-time highs on a weekly basis back in January. I said that's a worrying sign. When you did everyone, I saw on Twitter people say all-time high. When everyone's saying that, it's like the shoe shine boy, isn't it? That's a bit worrying. Now we've had a bit of a sell-off. I feel a bit better about it. I feel like we can rally from this base now and start to move into, rally towards the opening of the economy, because we rallied too early a little bit, I thought. So
I would, and I think again you've highlighted an excellent sort of example there. If you're an investor and your portfolio is at an all-time high, and you frankly don't know why. You haven't got a fundamental reason why it's at an all-high time. You need to do some serious work, because you will not be able to repeat that success. It's fluke, mate. That's what it comes down to.
But do you know what? And I saw it on Twitter. Everyone was saying all-time highs. I thought this is a red flag. And a lot of the thing about investing is counterintuitive psychologically. And I said you've got to try and realise fear sometimes is your friend. When everyone's selling off and we're at lows, that's the time to buy. When everyone's really bullish there, and the bull is out and everyone's pretty bullish, hey, you need to start taking a bit of profit maybe if you want to. If you're in good profit, maybe wait for the dip and but again you're getting into the realms of trading, which is very hard, and not many people can do it. And you just check out the stats on most of the big trading sites. 75% of people lose money like that. But I haven't changed. I knew back then we were in dangerous level when everyone was saying all-time highs. But I didn't particularly sell anything, because what's the point?
You don't need to, though, do you? I mean, you don't need it. You don't need it. What are you going to spend your money on anyway? Just hold the stocks.
No, exactly. I mean, one of the other guys on the weekend podcast say, I knew I should have sold some. I said, what are you going to do? Jump in and out. You can't time the market. And so, like, some of the worst days, are followed by some of the best days. So, and that stat, you missed the best 10 days in 10 years. And it makes a big difference to your portfolio value. And you're not that good. No one's that good. No one can spot every day like that and jump in and out. So,
and frankly, if it doesn't change your quality of life,
exactly.
Why do you need to sell any shares?
Exactly. And if you're holding good businesses and you like them, good. If you're in a business that's rallied and you didn't like it, and it's fluky rally, get out of it. Fair enough. But I mean, if the business you're in you like, hold on to it. Yeah. There we are. Anything else?
No, that's great. I'm looking forward to hearing about your new tech pick in EV or renewables in 2 weeks' time.
It's got to come down a little bit. It's just
buy it.
But have you ever bought something and it's gone up crazily? Because
yes,
when scaling in, that's a problem sometimes. Because I always scale in because I don't know whether it's going to go a bit lower here. But then sometimes you don't put a lot in, it goes nothing. Oh no! It's one of the times you hate to stop price going up. Because, part of you likes it, a third of you likes it, but 2/3 you think, oh no, because, But like I said, it's very hard to judge the bottom, but it's not a problem. It'll come back. All stocks come back a little bit, It's just a bit hot on the chart, But
all right, brilliant. I'll see you in a couple of weeks, Justin.
Okay, it's time for the top 5 most followed companies on Vox Markets in the last 24 hours. They are at 5 on the market, non-move at 90 pence. At 4, Guild Esports. 7.2% up to 5.9. At 3, Shield Therapeutics, 33.5 pence. STX ticker, of course, up just 1%. Webis Holdings down 10%, 5.2. And at 1, most followed, bouncing Bitcoin, which provides a bounce for Argo blockchain, up close to 15% at 227.5 Okay, it's time for the top 5 most read RNSs. They are as follows. At 5, Hemogenics, conversion of convertible loan notes. At 4, Omega Holdings. And that's Holdings in Company. Boring. At 3, Open Orphan, 7.5 million human challenge study contract. At 4, Bidstack, preliminary results, year ended 31st December. And at 1, Argo Blockchain launches first clean energy mining pool. That's it for the podcast. Thanks for listening. Muchos appreciated.
The Vox Markets Podcast with Justin Waite. Nothing in this podcast is intended as investment advice, and the people in this podcast may hold positions in the stocks they talk about. Do not buy anything based solely on a tip or recommendation. Please do your own research.